This is our Forex blog for April 23, 2013, and these are our currency indexes, which basically show you graphically how the dollar is doing, the yen, the euro, the pound. We compare all the dollar pairs, and if it's going up, we show bars going up. You can spot double tops, double bottoms, flags patterns, continuation patterns, reversal patterns. You can see trend lines. You can see breakouts of key resistance or breakdowns under support, like previous day's low in red, previous day's high in green. The point of control, which is the average price of all the dollar indexes, is right here. It's a major resistance level when the price is underneath it, and when it breaks that level, it's very likely to go up. So at 330 right here, you can see the dollar's trending up, the daily trend's up, the weekly trend's up. The euro failed at the high and is breaking down. Notice where the Swiss failed, right at the point of control. If a currency is underneath the hourly, it's more likely to go down. Above the hourly, more likely to go up. If you spot a currency going from below to above the hourly right here, and you can see the exact opposites happening here. The Australian's underneath it, the New Zealand's underneath it. Basically, you could be buying the dollar here versus the weakest pairs, the Australian, New Zealand, Swiss, and also Euro. When all the time frames line up, you can see the Swiss breaking the hourly right here, the daily and weekly trends down. So at 325, it's pretty high probability to buy the dollar Swiss. So here's 325 somewhere in this bar. You can see it also broke over the trend line right here. You're in that trade, and usually at our upper containment bands, and when the perfect oscillator hits 80, you really want to kind of tighten your stop. So I would have probably exited half the trade here and the other half here, wait for a little bit of a pullback, at least somewhere close to the white upper containment bands. You get into this trade, probably small profit here, very small profit here, and then the third one, you know, you're out of your half of your trade here and the other half here. You might have, because it went sideways for a while, nice little wedge pattern here, about to break out, you got out of half your trade here and the other half here. That's how I trade these. Now, if you were doing buying the dollar versus the Australian, which would have meant selling the Australian dollar, as soon as the Australian wasn't going down and broke out above the hourly, you'd want to get out of that trade. Now, the dollar's probably stronger than the Australian at this time, but if you sold the Australian dollar right around 3 or so, you're going to be watching that like a hawk, and you know, you always want to wait for price to confirm it, go below the previous bar's low, and so forth. If you went short right there and you saw that the Australian wasn't going down and it actually broke out above its index's hourly moving average, you know, at the very least you'd be moving your stop to break even, or, you know, tightening your stop, and you'd exit this with a very tiny profit for a lot of these trades that don't work. And that's how you use this. And there's so many things that you can do with it. For instance, the Australian's trend is down longer term. You can draw your trend line on this, and if it finds resistance at any of these levels up here, you can, you know, wait for the trend line to get broken. And sometimes trend lines get broken just by going sideways like that. I'm always kind of waiting for the next level. Here's the resistance here. If it can't get above it and then it breaks down, we're going to go short. Right here would be the place where I would do. You know, sometimes I get caught into trades when it's going sideways and breaks the trend line. It doesn't count as compared to when price actually breaks down. So at this point, which currency's strongest? Well, the pound just went from underneath its hourly moving average, which it was all day. The daily trend's up, the weekly trend's up. Just broke out right here at 725. So the pound Australian at 725, if you want to trade that pair, very high odds. There's 725 on that chart, somewhere around right here. You can see, unfortunately, this one only went up about 10 pips, but if you bought every pullback after that, you know, it continued to go up. Sometimes when you get into trades like this, let's go look at the index again. The pound has been going up for pretty much for an hour and a half. So sometimes you get breakouts like that. You know, you can see it's kind of going sideways, slowly inching its way up. This one's really not coming down. But if you bought every little pullback in that trade, you really want to kind of wait for the Australian to, I would redraw the trend line on this from here. You can hit the plus key to zoom in a little bit. It's still inching its way up. So if you get into a trade and it's not coming down, you want one to go up and one to go down. The CAD also right here, been going sideways for quite a while. You have a nice little wedge pattern on this. And anytime volatility gets into a narrow and narrow and narrow pattern like this, breakouts like this are pretty high probability. The Swiss is weak, the Euro is weak. You could buy the CAD. Let's just take a look at 830, selling the Euro CAD. You can see on the chart right here, the Euro has been trending down violently, coming up a little bit past 830. This one's kind of going sideways. You can see it pulled back about 20-25 pips. You have a very tight stop, and a real key to trading is to have these very tiny losses when wrong and significantly bigger wins. And using the indexes really helps you do that. So a lot of people like to trade just the main four pairs. And this, a lot of traders don't want to do the Australian pairs, CAD pairs, New Zealand pairs. Sometimes they avoid the Swiss pairs. From these four, you got the Euro dollar, Euro yen, Euro pound, pound dollar, pound yen, and obviously the Euro pound. If you see something like a double bottom right here, and obviously the weekly and the monthly trends up on this, if you spot a double bottom that then breaks out of this trend line, what a great, and it's right underneath the resistance area, and you can see that the point of control, the average price of the pound for the previous day was up 3 pips from the day before. Not anything very significant as compared to the dollar, which was up 32. The euro also went up more yesterday as a group of currencies than the pound did. But it is a resistance area, so when it breaks out through there, everyone was short, and most pound pairs is now losing money. They're going to be likely to cover some of their positions. Which currency is going down at that time? It looks like the euro is. The dollar looks like it might have support. The yen's trending up. So let's take a look at 640 selling the euro pound. And you can use any time frame chart, tick charts, range charts. I just have a regular chart up here because it's easier just to show a 5-minute range chart. So somewhere around 640, you have a nice little wedge pattern on this chart. It broke down, and again, you never know how much you're going to make on the trade. It went down to the lower band, but as long as you have trades that are likely to give you 1.5, 2 times more than your risk, you want to take the shot. And you also have your fib target from the previous move, and usually the market will work its way down there. It doesn't always fall immediately to that level. If you got short somewhere in here, again, this is your stop, this is your profit target, and it's 2.5, 3 times bigger than what your risk is. And anytime a trade moves your way, you want to put your stop, which is initially above that high by a pip or 2. You want to yank it down to break even. And anytime it goes your way, then kind of comes back down. I tend to move my stop down if I'm using a minute-based chart right above each bar's high. And when it hits the fib target, it's underneath our 2.0 band, and it also is at an extreme. Notice the perfect oscillator minus 80. Usually when those levels get hit, the market either goes sideways or reverses. You can see it pretty much went sideways there. This one right here did go up a little bit more than reversed. At an extreme here, it reversed. Right here, reversed. Right here, pretty much went sideways to up. Right here, you can see pretty much went sideways. It didn't go up. So the perfect oscillator is a great tool to be used by itself, and especially in conjunction with the Fibonacci profit target. This trade was right at the Fibonacci profit target. It was at an extreme likely reversal area, and our containment bands, which is a completely different algorithm, is also at an extreme reversing point. Notice the upper white level here. If you look at any chart The 2.0 white band tends to cause prices to reverse. Sometimes it goes a little bit beyond it, as you can see, but usually they don't continue past those levels, as you can see on this chart here. You see that? And these levels, you know, the market tends to kind of maybe drift down a little bit, then reverse up. It's very close to it right here. And these are statistical in nature, and you know, Fibonacci profit targets work because the biggest traders in the world use them. And a perfect oscillator works because it's also based on statistics at different times of the day and volatilities. And so all three, when they all hit, you probably don't want to be greedy, nor do you want to be stupid. Exit your trade, and in this case, catch 15 or 18 pips while risking 7 or 8. It's a good profit based on a very tiny risk.